Good evening, everyone. Thank you for joining us for our expert-led educational series. And today our expert is Ankit Bhavishi. Ankit is founder and principal of Blue Acre Capital. He oversees capital raising, underwriting, and capital markets for the firm. Prior to founding Blue Acre Capital, Ankit spent 10 years in the investment banking industry and providing a range of services, including mergers, acquisition advisory, capital raising, financing, and debt reconstruction for domestic and international clients. Ankit has a Bachelor's of Science in Business Administration with a concentration in finance from University of Florida, and received his state of Illinois real estate license. So Ankit, thank you so much for taking the time to be here. Welcome. And the floor is yours. Impart your knowledge on us, please.
All right. Well, thank you so much for the introduction. I'll get right into it. So, a little bit about me, Deepa kind of covered it, but just to reiterate, my name is Ankit Bhavishi. I'm the founder of Blue Acre Capital. I formed this company last year after spending about 10 years in the investment banking industry, where I focused on mergers and acquisitions, capital raise work for large healthcare companies throughout the US and globally. I've executed about $3 billion in M&A and capital raise assignments for these companies. I'm a graduate of the University of Florida, and I'm also licensed by FINRA with my Series 82, 79, 63, and 63 licenses. Before we continue, if you could just please take a look at this disclaimer. It's basically indicating that this is a presentation for informational purposes only. It's not intended to provide any advice. It's not an offer to sell securities. The information contained herein is confidential and shouldn't be shared without permission. All right, perfect. So I'll start by saying there are multiple ways to underwrite an opportunity. There are obviously wrong ways, but there are also many correct ways. We could spend hours talking about every little aspect of underwriting, and obviously we don't have that much time. So we're not going to get into every basic concept, but we're going to essentially cover the approach that Blue Acre takes when we're vetting our opportunities, and give you an idea of what to look for when you're vetting opportunities for yourself. In a market like this, I find that it's very helpful to be as refined and detailed as possible so that you're able to put your best foot forward for us when we're submitting our LOIs and putting offers on opportunities. But when you're evaluating, as investors, if you're evaluating a sponsor's opportunity to decide if you want to invest in it, you'll want to know what approach have they taken, have they been conservative, and what does that actually mean? So to get into it, we're going to cover two key high-level areas in underwriting: market analysis, where we're going to cover the different statistics we look at to evaluate, population, employment, crime, supply, demand, and median income. And then the property-specific analysis, where we'll cover the P&L, income, expense, CapEx, reserves and costs you can expect, and the typical returns of an opportunity. So we'll start with market analysis. We underwrote this property a few weeks ago before the markets really blew up, but we're going to use a Jacksonville, Florida property as an example. The first statistics we look at when we're evaluating a market is the population, unemployment rate, and crime. So when we're talking about population, our Blue Acres criteria is metro areas that have a population of at least 100,000. In this case, you can see as of April 2020, Jacksonville had almost 1 million in population, so we're well above that. But we typically like to see that a specific market is growing over a 10-year period. We like to see that growth rate to be about 15%. In the case of Jacksonville, it's about 16%. The unemployment rate, our criteria is that a metro area have an unemployment rate that's below the national average. So we looked at the Florida's unemployment rate was 3.5% as of December, and Jacksonville's unemployment rate was 3.2%, both of which were below the 4% national average. For crime, there are varying sources that provide different indices that use different numbers as their scale. So there's not really a one size fits all metric that you can use, but what we typically use, we've used city data. There's also a website called spotcrime.com. We use these to just gauge the area, make sure that it's not like a class D or rough area. And if there's an index that actually quantifies the level of crime, we like to see that index trending downward over a 5 or 10 year period. Next thing we look at is supply and demand. So there are a few different metrics that you can evaluate to gauge, what the supply demand dynamics are for a market. Average market occupancy. So we typically pull this from a CoStar report. It'll tell you the vacancy rate or occupancy rate. We'll look at the market rent growth. So if a specific area is seeing continuously rents growing at 6-7%, that's a great sign and strong indication of demand. Units under construction and its relationship to projected renter household formations. So we basically look at the number of units that are being constructed, and based on certain third-party sources, we can calculate what the projected renter household will be and calculate a multiple called renter demand multiple, which basically tells us of the number of renters that are expected to come to a certain market and the number of units that are apartment units that are being constructed, is there enough demand for the units being constructed? Typically, this renter demand multiple will be at least 3 times. So 3 times the number of renters to units that are being built. The next thing we'll look at is deliveries versus absorption. So we can pull this information from CoStar and certain other sites, but this compares the number of units that are being delivered to the number of units that are actually being absorbed or occupied. So in a situation where deliveries are greater than absorption, this can be an indication of a potential slowdown in a particular market. You've got too many units being built and not enough being absorbed by potential tenants. And then vice versa, if you've got deliveries that are less than absorption, you might have a situation where there's that might be an indication of market growth. I would say that it's important to analyze, not to look at any one metric that I've listed here. It's important to look at them together. So, if you have a situation where deliveries are greater than absorption, which is an indication of a potential slowdown, you might want to look at the rent growth and occupancy levels in that market. And, if there's a situation where rent growth is slowing and occupancy levels are declining, it might be an indication that there's a cooling period, or there might not be as much demand going forward. And it's just something to keep an eye out for. The next one is the median income analysis. I think this is really important, especially with where we are today in the market. Rents every day, we're seeing new statistics coming out where rents are rising 15, 20, 30% at a time. And there's a question of how sustainable is it? And can the incomes of the people in those markets support it? So we pay very close attention to the income levels, and we drill down from the city to the zip code to a specific block that the property is located. And we're able to determine if the in-place rents and the pro forma rents that we're projecting can be absorbed based on the income available. To gauge this, we look at 2 key ratios. One is the income to rent multiple, which we want to be 3 times. So that's calculated as the median income divided by the total rent for the year. And if that multiple is at least 3 times, that's a positive. The other metric is rent as a percentage of income. So same thing, but vice versa. We want to see a maximum of rent as a percentage of income at 30%. So this Jacksonville property, we've included an example in the table of how we look at it. So any specific market, we have a criteria that the minimum median household income needs to be about $45,000. We might increase that over time, but right now it's $45,000. The city of Jacksonville's median income was about $56,000. Based on the in-place rents of the property, we're at 5.2 times, which is well above the 3x, which indicates that there's some room to raise rents. If you look at the pro forma column, you'll see that our pro forma assumptions still maintain a 3.9 times multiple, which gives us some cushion in case there's some kind of a change in the market. Same thing on the rent as a percentage of income. You'll see that for the city, the property's in-place rents are about 19% of the median income, and then our pro formas get to about 26%. One thing to keep in mind is, the income data can be stale, especially when you're pulling it from certain sources. It could be a year or two old. We do know that from our conversations with property managers and brokers, incomes have been rising. The best data is really going to come from the applications that are being submitted to the specific property by prospective tenants. So they're going to report their income, and then that's real-time data. So what we would do, that's hard to come by, but what we typically do is once we get a property under contract during our diligence period, we're able to kind of vet that to make sure that whatever our pro forma rents are being assumed, it's supported by the incomes that are from tenants that are applying to the property. So that is no, of course, the other thing I was going to say was, we also want to look at rent comps to make sure that, our rents are in line with the surrounding properties, but we'll get more into that. And so that's kind of how we, at a high level, how we look at the market that we're looking in. And typically, most operators, they're going to focus on specific markets. So once you do this type of analysis once, you're not doing this over and over again. And the expectation is that when you find a property that might be in some niche part of a specific city, you might do a little more digging around like that specific zip code or block. But for the most part, major metro areas aren't drastically changing over time. In Jacksonville, we expect that it's going to continue to grow, and we love that market. So we'll continue to look there. But getting into the property analysis, so the first thing we look at is something called the unit mix and rent analysis. You want to make sure that whatever property you're looking at has a desirable unit mix that's supported by the demographics of the location. So are there students? Are there single people? Are there married couples, families? Can this property support that population? And in this case, you'll notice that about a little over 50% of the units are 2 and 3 bedrooms, which is great. We'll also look at the current vacancy. This specific property had about a 2.9% physical vacancy at the time of the underwriting. That's a pretty low vacancy, and we can't really expect that the property is going to continue. I think across the country, properties have been performing very well. Vacancies have been declining significantly. But as we'll see in a few slides, we can't expect that that's going to continue, and we want to account for that in our numbers. In-place rent versus market rent. So we want to know what are the current rents that are in place, and then what are the market rents. And we define market rent as new leases that have been signed within the last 30 to 60 days. So for this 2-bed, 2-bath small, 2-bed, 2-bath S, you'll see that the current rent average is $956, but we're showing a market rent of $1,060. What that means is in the last 30 to 60 days, there have been a few units that have signed leases, a few 2-bed, 2-bath units that have signed at about a $1,060. So we believe that without having to do anything, we should be able to go in and raise rents by $100 or so to keep up with the market. The pro forma rents are essentially the rent premiums over and above our market rents that we would only be able to achieve based on the implementation of our value add strategy. We always want to make sure that whatever our market rents and pro forma rents assumptions are being used, we want that they're supported by local rent comps, which you can pull from independent research, online sources, or the best source is a property manager who can provide a lot of guidance based on their experience with properties in the area. So now we're getting a little bit into the numbers with the operating statements. We'll start with the operating income. I'll cover certain line items here. So gross potential rent is essentially in the T3 column. That's the actual in-place financials of the property. The stabilized column of the table is where we expect to take the property once we implement our value add strategy and cost efficiencies. Gross potential rent is essentially the total achievable market rent at the T3 level. And then when we look at the stabilized column, it's the total achievable pro forma rent. Loss to lease is the difference between that total achievable rent and where rents are today. So this is a very important number that I think, I want to kind of spend a couple minutes on, because I've seen this number used in different models and calculated different ways. Some operators will use a random plug, like say 5% for loss to lease, and use that going forward. Others will take whatever the loss to lease is in the T12 or financials and just plug that in as the starting point. But Blue Acre and what a lot of experienced operators, what they do, you can actually calculate this number. And I think it's important because the loss to lease number that might show up in your T12 that you're provided is going to be based on the seller's analysis of where market rents are and where their current rents are. So you want to be able to calculate loss to lease based on where you think market rents are relative to the current in-place rents. So in this case, we were able to take the current rent roll and subtract whatever the current rent roll rent's total income could be from the gross potential rent that we will be able to attain. So we're starting with a loss to lease of about $345,000. And to my comment earlier about how some people will just use a plug of 5%, you'll see that loss to lease is about 18% of the gross potential rent, which is obviously a big difference, and brings your total economic vacancy to almost 20-25%, depending on the property. So it's very important that you don't use a plug and that you calculate numbers wherever possible. And over time, as we stabilize, we expect to bring that loss to lease down to about 2%, with the idea being that we'll never be able to bring rents all the way up to market. There's always going to be some disparity, so we want to account for that. Gross schedule rent, as I mentioned, that's basically the total rent that can be achieved based on the rent roll, the current rent roll. Vacancy is essentially physical vacancy, accounting for downtime. Are units completely vacant? How have they been offline for a couple weeks because of unit turns or whatever? One thing that I want to emphasize is that this is a number that can also be calculated. A lot of times, and we'll get into it right now, but a lot of times people, like lenders, for instance, will assume a 5% vacancy in their underwriting. It's standard because most properties throughout the country, the average vacancy is about 5%. But we think it's important to factor in the downtime for renovations and the downtime for a standard unit turn. So in our model, we assume that any renovation is going to take about 30 days, and any unit turnover from just changing out a lease will take about 2 weeks. So in this table, in this example from our Jacksonville deal, you'll notice that we stabilize our vacancy to 5%, which is where lenders typically underwrite to, but our beginning vacancy is slightly higher because we're accounting for 77 units being renovated the first year, and then the remaining units that aren't renovated are just going to be turned through a standard lease turn. And then year two, the remaining 63 units are renovated, and then the units that aren't being renovated are going to be turned again for new leases. Obviously, 6.5% is not materially higher than 5%, but again, I think it's very important to be as refined as possible so that you can be more aggressive in your assumptions in other areas. Coming back to the operating statement. So concessions, these are essentially rent reductions and promotions that tenants receive, to attract tenants to a property. In this case, you'll notice that it's virtually zero. And I think we're seeing that across the board because occupancy levels are so high, landlords don't really have a need to provide concessions. So we underwrite to a stabilized concession rate of about zero. Bad debt, that's essentially the rent that's not being collected from tenants and that needs to be collected. A lot of times it ends up being written off. Again, you can see in this property, there's very low collections. So it's an indication that the property is performing very well, good tenant demographic. But we try to assume that there will be some bad debt going forward. So we underwrote to a higher rate than what the current performance is of about 0.5%. Ratio utility billing system, which is RUBS. This is essentially a bill back process for apartments. So a lot of times apartment communities will pay the utilities on behalf of the tenants and then bill that back to the tenants. We were able, in this particular case, we found out that based on like analyzing where the RUBS amount about 100,000 off the T3, we determined that they were charging about $60 per unit per month for each tenant. We, based on our market survey, we thought that that was in line. So we assumed that going forward, the RUBS was just going to remain at about $60 per unit per month. And then finally, the stabilized revenue increase, number 8. I think this is an interesting metric. What this quantifies is the increase in effective gross income from your T3 in-place financials to where you will stabilize the property once you implement your value add strategy. This is a good number to quantify the level of execution that you're going to need to implement and hit your target. Anything above a 20% is indicative of a value add property. Anything less than that is probably more of a Class A, Class B cash flowing. You're just coming in and burning off loss to lease. But at 27%, you can see that there is some level of work involved and some level of risk involved in bringing our property up to where we want it to be once we renovate. Operating expenses. So this is a big one, and I think it's very important to pay very close attention to some of these expenses, especially property taxes. You'll see in the T12 financials that we've listed here, property taxes were about 162,000. Anytime a property goes through a sale, depending on the market and the municipality you're dealing with, there's a good chance that the property is going to be reassessed and after the sale. So I think, with this property, our analysis indicates that our property taxes are going to go up to about 300,000, which is an 84% increase over the current taxes. That's a material amount. And a lot of times you might see an operator list a property tax number. And if you don't have the prior year financials, it's important to ask for them just so you can check what are the property's current taxes. And if they're showing that the current taxes are 162,000 and they're projecting that it, going forward, it's going to be 170,000 or 180,000. They're just assuming inflation is the taxes are going to go up with inflation, which, maybe, but you want to check that because there's a good chance it's going to be reassessed. Insurance is another number that can be a deal killer. We've been seeing insurance premiums rising significantly. In our preliminary underwriting, we typically assume that whatever the insurance premium is, we're going to increase it by about 20%. We'll back that up by getting an actual quote from an insurance provider. So if you're evaluating a deal from a sponsor, you just want to make sure that whatever insurance number they're providing is based on some methodology outside of, hey, this is what the property's current insurance is. Ask if they got a quote from an actual insurance broker or, some kind of reasoning for it. Repairs and maintenance, the existing property expense for repairs and maintenance was about $64,000 or $459 a unit. We assumed that going forward, that number was going to go down to about $350. Even that number, I think, might be a little high, but we typically use this for our underwriting purposes. The idea being that when you take over a property and you go through an extensive value add program, you're going to cure a lot of the repairs and maintenance that might be ongoing with the property. So chances are that $350 per unit might come down a little more, but we try to underwrite to slightly higher. Turnover, same idea. Turnover basically accounts for when a lease expires, the tenant moves out, and you're bringing a new tenant in. You got to repaint the walls, clean the carpets. There's certain things that when you're going through your value add project, certain items are going to be cured. So even though the property is currently at $350 per unit, we're bringing it down to $300. There's still probably some more room for cost reductions. Generally speaking, a lot of larger properties will show repairs and maintenance and turnover separately, but we try to look at it on an aggregate basis, and we want that number to be about 500 to 700 per unit for underwriting purposes for a Class B or Class C property. Let's turn over. Okay. Operating expenses continued, replacement reserve. So this is another number to look out for. This is a lender required reserve. There are some operators that will include this number below net operating income. So the net operating income number looks higher. We typically include this number above the line, which means that it's going to be netted out of net operating income. The assumption is that we're going to spend that money for whatever that comes up, and it's a way for us to remain conservative. But there's no right or wrong answer here. You can include it either way. It's just one way is more conservative. And then the operating expense ratio. This is the percent, the total expense relative to your total income. We typically like to see this number in the 40 to 50% range. As you can see here, the current property is at about 51%. Will stabilize around 46%. Generally speaking, when we're evaluating these P&Ls, we'll do our own analysis and then work with a property management team to kind of further refine the numbers. Ask them, hey, are our expense assumptions realistic? Has payroll expense gone up because wages are rising? Has repairs and maintenance gone up because the cost of materials has gone up? CapEx budgets, we might be projecting $14,000 per unit in renovations. Is that accurate? Is it lower? Is it higher? You always want to make sure that you're working with a property management team alongside your standard analysis protocol. So key assumptions, obviously there are a lot of assumptions here. We're not going to go through every single one, but at a high level, I think this is a really good slide because it really shows on one page the key assumptions that drive a model and can really manipulate your return numbers. When you get an OM from a sponsor, you might not get access to this unless you specifically ask for the financial model. They might provide some certain assumptions, but for the most part, you're just going to get a pro forma P&L statement that just shows the results of the assumptions. And so I think it's very important that you have an idea of what assumptions should be on a conservative basis and be able to ask questions to sponsors to understand, are they truly being conservative when they're providing their underwriting? So for this specific property, our rent growth, we assume a year one, 3% rent growth, and we stabilize it throughout the whole period at about 3%. In today's market, that's pretty conservative, given that in Florida, we've seen 10%, 20% increase over the last year or two. But even historically, prior to COVID, rents were going up on average 3 to 5%. So we felt comfortable running our rents at 3% growth rate. Vacancy. So this is total vacancy is basically economic vacancy. If you recall on that OpEx table slide, we were showing total economic vacancy based on in-place financials of around 20%. The idea would be that we stabilize over the renovation period, which is 25 months, to about 7.5%. Loss to lease is the only vacancy metric that we stabilize in a quicker duration, because loss to lease is essentially bringing your current leases to market, and most leases tend to be about 1 year. So the idea is that within a year, we should be able to raise in-place rents to market rent. And then further increases from market to pro forma would be based on that 25-month renovation period. So you'll see the rest of our vacancy numbers are physical vacancy, bad debt model, the model unit and concessions are brought from wherever they are today to our stabilized percentage over that 25-month period. For expense assumptions, we believe, inflation is a thing. And if you're going to apply the rule of inflation to rent, you have to assume that that same thing is going to happen to your expenses. So a lot of times you'll see operators say, oh yeah, we project 6% rent growth year one, 5% year two, 3% on the balance. Well, that's fine, but what about your expenses? Are you assuming 2% based on historic inflation? That's a tough thing to believe. So for our underwriting, we try to be conservative and we just tie our expense growth to whatever our rent growth is. So if we're going to project 4% rent growth, we'll tie our expense growth to it just to kind of know that we're keeping up with inflation. Real estate tax, this is a big one. You'll see our real estate tax expense grows at about 5.8%. This is a formula we've created that basically ties our property tax growth to the income of the property, because property taxes are derived based on the value of the property, and the value of the property is derived based on the income. So if you're projecting that your income is going to grow substantially over time through a combination of rent growth and loss to lease burn off and cost reductions, you need to be able to factor that in. And we started doing this because when we were doing we do a 5-year look back on all the properties, 5-year tax look back on all our properties, and what we found is a lot of properties in Florida, property taxes were rising anywhere from 5, 10, and even 15% at times per year. Obviously, we don't want to assume 10% and 15% per year, because then you'll kill any deal. But we didn't want to use 2% either, because that's just keeping up with inflation. So we wanted to fall in between, and we found that creating a formula to kind of calculate that was the best approach. Property taxes, we covered that, how we reassess based on the purchase price. This is very market dependent. So, in Florida, it's common that, properties are reassessed at about 83% of the purchase price. In places like Texas, they might be reassessed at 90% or 95%. So it's very important to get this number right, or at least accurate. Our renovation assumptions. So here we kind of lay out what our model assumes. In this particular case, based on conversations with our property manager, we got comfortable with renovating 7 units per month, which equated to about a 25-month renovation period. Our renovation budget was about $14,000 per unit. This is on the higher end for our property. A lot of times you'll see them in the $7,000 to $10,000 range. If you see a number that's in that $5,000 per unit range, just want to ask the question of what is the scope of work? Has this been vetted with the property manager? Is there a basis for that budget? Financing assumptions. So this is a big one as well, especially with where we are in the market today. This particular deal, as I mentioned, we looked at this before the capital markets really blew up. We're assuming a bridge loan product, which is essentially a risky loan product that can be used to acquire a project and enhance your returns, because you're able to finance your CapEx budget in addition to the purchase price. 80% leverage is obviously very high. In today's market, we're not using a bridge. We're not really looking at bridge. We're still evaluating it, but we're really focusing on agency longer term debt where we can get 55 to 65% leverage. But I wanted to show this in case you do come across a property from an operator who is using bridge, and some things to look out for. Like I mentioned, bridge loans tend to be about 3 years. A lot of times they're floating rate, and nothing wrong with that, because most lenders require an interest cap that needs to be purchased, which basically fixes. So if your floating rate is at like 2%, if rates rise to 5% and you buy a cap at 4%, you're basically protecting your upside or your downside by capping how high your interest rate can go. But that cap comes at a cost. So if you want to buy a cap that prevents your interest rate from going above 4%, depending on the property, that could cost $500,000, $700,000, especially in today's market. And so you want to know, has that been accounted for in the equity raise? You know, that's got to be raised and part of the budget. In addition, you know, in this particular case, we're planning to hold this property for 5 years. Bridge loans tend to be 3 years, and you have to purchase 2 one-year extensions. Those are an additional cost. They can range anywhere from 25 basis points to 1% of the loan amount per year. So in our case, we got a quote from our broker that 2 extensions would be 50 basis points per year. So we factor that into our total reserve to make sure, because we plan to exercise it when the time comes. Finally, our exit assumptions. So another, you know, very important, very sensitive part of the analysis, we are assuming that cap rates will expand over the 5 years by 10 basis points per year. Some would argue that's a little aggressive, especially given what's going on in the market. But it's more a function. It's a function of multiple things. It's supply-demand dynamics. It's interest rates, and so in a market like Jacksonville, where the population is growing, there's limited supply, people are fighting tooth and nail for a place to live. We feel confident that there is room for the market to continue to appreciate or at least remain stable. So increasing our cap rate by 10 basis points per year, we were comfortable with that. One thing you don't want to see right now is someone buying at a 4% cap rate and exiting at a 4% cap rate. In our situation, we're buying it at a 4% cap rate and exiting at a 4.5% cap rate, which, you know, is conservative in our eyes. CapEx costs and reserves. So just to touch on this quickly, you know, we talked about $14,000 budget. That includes our interior renovations and expected exterior renovations. We also factor in a 10% contingency in case there are cost overruns, labor shortages, anything that might drive up costs unexpectedly, and a 5% renovation management fee budget that gets paid to whoever's managing our renovation project. Acquisition costs tend to be about 2% of the purchase price. This is backed by detailed line items of different costs, like mortgage documents, environmental studies, all the different things that go into closing a deal. Acquisition fee is not included in this. That typically is around 2%, depending on the operator. We also factor in reserves for our deals. So we factor in 4 to 6 months of taxes up front. We fund insurance, the full year's insurance up front, because that's expected to be paid at close. We budget about 1.5 to 3 months for operating reserves. So we raise about 3 months of expenses and debt service up front in case something goes wrong. And then our bridge extension fees that I mentioned earlier. And then finally, our return metrics. So this is one of my favorite slides. I think, everybody likes to see, wants to make money. So one of the things we look at is yield on cost. I like this a lot because it's essentially your cap rate, which is your net operating income divided by purchase price, but it's your cap rate once you stabilize the property and implement your value add strategy. And it's calculated as your stabilized net operating income once you renovate the property and cut costs, divided by your acquisition price plus the CapEx that's needed for the value add. And what's great about this metric is that it helps you compare a value add property to a Class A, for instance, to see, okay, if we're buying at a stabilized yield on cost of 6% and there's a Class A property that's selling at a 5% cap rate, that 1% differential, is that enough compensation for the added risk of taking on a value add property? So that's a really nice metric to kind of keep track of. Yield on cost to exit cap spread. This is basically the difference between the yield on cost and the exit cap rate. And so in this case, that number is 58 basis points. And this helps this basically represents the amount of value that you're creating, that once you renovate the property, you're exiting at a higher stabilized at a stabilized yield on cost that's higher than your exit cap rate. And 58 basis points in this example represents significant value being created for investors. Different investors are going to look at that number differently, and they might think that's not high enough, or it's perfect. So limited partner IRR, I think most folks know what that is. It's basically, this is the net return after the sponsor receives their asset management fees. And then another thing that you might want to pay attention to is something called the IRR partition. This is basically an evaluation of the return that an investor receives, and where is that return coming from. In this case, you can see that 22% of your total return is coming from cash flow, and 77% of your total return is coming from the eventual sale of the property or the refinance event. And what this comes down to individual investors, and also indicative of the market. Florida is not known to be a cash flow market. It's known to be an appreciation market. So this is typical profile. But in places like Indiana or certain states in the Midwest, you might see an IRR partition where the cash flow represents 40% and your capital event represents 60%. And different investors will have different preferences around how, the level of risk they're looking to take for an opportunity. So,
well, thank you so much. We really appreciate your time. And guys who are watching this on the recording, please connect with Ankit on LinkedIn, and you have his email address, and reach out to him if you have any questions. Thank you for your time, Ankit. We really appreciate it.
Yeah, appreciate it. Thank you for having me.